Assalamualaikum and good day everyone. My name is Nurhaziqah Syaziah binti Muhammad HAZRI. My matrix number BB221105661. This is my individual video assignment for Bc30803 Islamic Financial Economics. In this video, I'm going to explain three things, which are the definitions of Islamic bank financing and conventional bank loans, the core differences, and the last part is the advantage and disadvantage of it. So let's start with some basic definitions. Islamic bank financing is based on Sharia or Islamic law, which strictly prohibits interest or what's known as riba. Instead of charging interest, Islamic banks use profit-sharing models and only invest in ethical, socially responsible ventures. On the other hand, conventional bank loans operate on an interest-based systems. Here, the bank lends money with the expectation of getting paid back with interest on top. The focus is on maximizing profit, primarily through interest from borrowers. So, while both systems aim to support businesses and individuals in obtaining finance, they are built on different principles. Now, let's dive into some of the core differences between Islamic financing and conventional bank loans. The first and most fundamental difference is the concept of interest or riba versus profit sharing. In Islamic finance, interest is forbidden. Instead, Islamic banks operate on profit sharing models such as musyarakah or mudarabah. And here, both the bank and the client share profits or loss based on the performance of the investment. In contrast, conventional banks charge interest on loans. This means that no matter the outcome, the borrower must pay back the loan amount with additional interest. The bank has guaranteed profit through the interest, while the borrower bears all the financial risks. The next major difference is risk sharing. In Islamic finance, both the bank and the customer share the risks and rewards of the investment. This makes the bank more involved in the success of the venture and aligns its interests with the clients. In conventional banking, however, the borrower assumes the full risk. Even if the venture fails, the borrower is still obligated to repay the loan with interest, and the bank's role is limited to being a lender with no further engagement in the business. Now let's talk about the types of contracts. In Islamic banking, there are several types of Sharia-compliant contracts, such as murabaha, which is a cost-plus financing model, and ijarah, which is similar to leasing. These contracts offer specific ways to structure financing in line with Islamic principles. On the other hand, conventional banking uses simple loan contracts, where the borrower agrees to repay the principal amount along with interest over a set period. This straightforward structure lacks the complexity of risk-sharing models seen in Islamic finance. Now, let's look at some advantage and disadvantage of each system. Islamic finance offers several unique benefits since it is based on ethical principles. It encourages investment in socially responsible projects and excludes businesses that might be harmful to society like gambling or alcohol. The risk-sharing element also promotes a partnership between the bank and the client, which can help reduce financial hardships if a business faces challenges. Conventional banking, however, has its own advantage. The loan process is generally simpler and faster, and borrowers may have access to flexible loan terms. Additionally, fixed interest rates can make budgeting easier, as clients know exactly what they will owe each month. In conclusion, Islamic and conventional banking offer two different approaches to financing. Islamic finance focuses on ethical investing and risk sharing, while conventional banking emphasizes profitability through interest-based lending. Choosing between the two depends on one's financial needs, ethical considerations, and personal beliefs. Thank you for watching, and I hope this video has given you a clearer understanding of the differences between Islamic bank financing and conventional bank loans.